Hello there. Well, stock markets have done very well of late, in particular those in the US. And as we've made the point in the last couple of editions of the Pulse, sentiment has been quite buoyant, and that can be a little bit of a concern because, as I say, markets have done extremely well. In fact, they've actually, in many cases, done better than most people were forecasting at the beginning of this year. So they're already ahead of where a lot of people thought they would be at the end of the year. And of course, markets can be volatile. We often get what we call a correction, which is when the stock market falls about 10%. In fact, as you'll have seen in the last edition of the Pulse, we think generally we see that a correction tends to happen almost every year. And it doesn't matter whether that year ends up being a good year for stock markets or a poor year for stock markets, you nearly always get a correction, and we haven't had one for a while. So that makes us just slightly nervous that there might be one around the corner. If so, though, it's important to remember that it shouldn't be anything to worry about. It shouldn't be a surprise. And in fact, for a multi-asset portfolio, such as our core funds, it should actually be an opportunity, because what we can do is switch some assets out of lower risk investments that have hopefully held up well and use that to buy equities at a relative low, and then hopefully we benefit from a rebound. So more recently, we have also been slightly reducing equity exposure in the core portfolios, mainly because we've had some defined returns kick out and we've just not necessarily reinvested them in equities, but put them back in things like high yield bonds, which, as we've said recently, we've got a very positive outlook. If we did get a correction, we can then reverse that. So, of course, we could be wrong, and in a way we hope we are wrong and that markets just carry on going. We could also be wrong in a different way, of course, and that if we did get a correction or a fall in markets, it might not be a mild correction. It might be something a bit steeper, more of a bear market. We don't think so, but there are ways we can protect against that potential outcome. So we can take out insurance in the portfolio in a bit like you can take out insurance for anything else. So for portfolio insurance, like anything else, you pay a premium to get that insurance. And of course, you hope the insurance doesn't pay out. We hope that the stock market carries on going and we get some good returns. In that case, by buying the insurance, we've slightly reduced the returns, the growth that we might get, but that's okay because it gives us some peace of mind. In the event that the stock market does fall, we're still exposed to the first 10% fall in markets. That's kind of like the excess on the insurance policy, if you like. But essentially, with our portfolio insurance policy that we've taken out, anything more than a 10% fall, we're covered. So that applies to the US stock market. So our insurance policy is only on the US stock market. And at the moment, these premiums are relatively cheap. And we've generally taken out an insurance policy that covers about 10% of the portfolio. If we start taking one that covers up the whole portfolio, for example, then it will start to get a bit more expensive. So what that allows us to do actually is keep equity exposure that bit higher. If we've got an insurance policy that will pay out if the market falls sharply, we don't have to worry so much that that could happen, even if it's only a small eventuality, a small probability. But it means we can keep higher exposure, and then if the opposite happens and markets keep on growing, then fantastic. We'll see some really good returns, slightly lower than we would have got had we not taken out the portfolio insurance. But if we can keep exposure higher as a result, then we should still see a really good outcome in our view. So as always, we're trying to think about what might be the risks to the portfolio as well as the potential returns and trying to get that balance right. And in particular, that's important at the moment because, of course, we've got elections coming up. Now, as we said a few months ago, we're not particularly concerned that the UK election will have a big impact on the portfolios, but perhaps the US election could do, particularly if Donald Trump does some, Donald Trump gets in and does some tax cuts and puts up spending, then that might have implications for inflation. It might have implications for interest rates. So that could have more of an impact on portfolios. So we just think it makes sense at the moment with so many things going on to just be mindful of those risks and be a little bit wary, but also making sure that if the worst doesn't happen and markets carry on going up, that we still get as much of the gain as possible. So that's what we're doing at the moment. I hope we found that helpful, and we'll see you next time. Thank you.